We've got to talk the dollar index. It has had a rough go of it this year. Look, ever since the start of the year, when Trump took office, we've seen really nothing but unrelenting selling in the DXY. And normally, I wouldn't actually be that concerned about the dollar pushing lower. It can very much be explained by the normal ebb and flow of the business cycle. In fact, I'll make a case in just a second why, generally speaking, the dollar pushing lower does coincide with kind of healthy, growing macroeconomic conditions. However, in this instance, there is kind of a why, an explanation as to why the dollar is pushing lower now that is quite concerning. That's what we're going to talk about in this video. So let's go ahead and get into it. Before we do, though, if you're new here, make sure you get subscribed to that notification bell on. And give this video a thumbs up on the way out if you find it particularly helpful. All right, what we're going to do is we're going to juxtapose two kind of paths here of what we're seeing in the dollar. And I'm going to give kind of the argument for why I think we've seen the dollar path, this kind of ebb and flow higher, this kind of longer term trend upwards that we've seen over the last, say, 15, 20 years. Why that's been taking place, and I think that is absolutely the reason why we've seen the dollar perform the way that it has. And then this alternative view that I think is what Warren Mosler is putting forward as to what is possibly causing the dollar pushing lower, and why this time it is kind of different, why the dollar collapse that we're seeing is actually going to lead to some very poor outcomes in the not too distant future. And look, at the end of the day, I truly am concerned about this alternative path. If this is taking place, if the why is taking place, it is concerning, and the end game is not much fun. I mean, it really will lead to kind of a market crash, and it could be the path that we're on where maybe, say, by 2026, we start to realize this is where we're at. So, yeah, that's what we need to talk about today. So first, let's do this. What has been driving the dollar, say, since about 20 years ago after the end of the great financial crisis, right around that time period, maybe even further back than that, but certainly since we've seen that the big bull market, longer-term upward trend in the dollar, what's been causing that? Well, one of the things, and there are many kind of common mainstream arguments for what drives foreign exchange, and some of them have more validity than others, probably for another video, but the interest rate parity one is definitely backwards, but some of these have some credibility to them. But to me, one of the major overlooked features to what drives the dollar in its current path is just this massive demand. And a lot of the demand has to do with the fact that it's been used. It gets spent into existence. The U.S., certainly since the great financial crisis, has really been the only one on the block who's been wanting to spend and create the dollars. And in a world of floating exchange FX, in a world of fiat money, you really got to use it or lose it. And in this case, the U.S. has used it. And since the world has been flooded with dollars just due to massive fiscal expansion in the U.S., there's also even more of a demand than what the fiscal side has provided to utilize these things. So you end up getting credit creation. And so when the business cycle starts to pick up, new loans create new deposits, more dollars are being created because there's demand for those new dollars, and this pushes the dollar lower. One of the reasons the dollar pushes lower, and in fact, you can see this. What I've done is highlighted the periods of relative dollar strength to relative dollar weakness, and during dollar weakness periods, that's when you see the expansion of the S&P 500, just using that as kind of a proxy for growth. And then on the reverse, when you see the dollar shoot up very, very quickly, it's because we're likely getting a credit crunch. There's a massive immediate demand to own dollars to pay off your debt. That actually reverses the process of creating the dollars. There's dollar destruction, and then dollar pushes higher. And so that's why during those periods, it usually coincides with relatively bearish macro outlooks. And so that turns out to be kind of the cycle for why we've seen this longer term upward trend where you get this credit creation that kicks off the business cycle that pushes the dollar down. The dollar falls until the cycle peaks. You get a global credit crunch. At that point, you see this very swift upward motion of the dollar. As you get almost like a short squeeze in the dollar pushes higher. Of course, at that time, because you're at the top of the business cycle, you'll have kind of the automatic stabilizers kick in. And this is going to be key too. When these automatic stabilizers kick in, usually you're in kind of an approaching disinflationary type situation because the business cycle is collapsing. And so those automatic stabilizers are kicking in a environment where there is, at a real level, fiscal strength is quite strong. That leads to a recovery, and then the world returns to normal where the credit cycle can kick off again, and we repeat the cycle. And like I said, that really goes back, and we've seen this cycle play out multiple times going back to the great financial crisis. And really, I would say this all kicked off, or the seeds were sown for this going all the way back to when the euro came on board and the Maastricht Treaty set off the eurozone to where the eurozone was effectively self-restricting their own spending via the Maastricht Treaty for reasons that they thought was best. That killed the euro, allowed the U.S. to really become the main spender on the block. Now, why does this spending matter? Why does this business cycle matter? And then why could this cycle be reversing? Well, one of the things that is key, and has been key, especially over the last 20, maybe even going back 30 years, actually maybe even going all the way back to the 70s and 80s when the U.S. became the kind of the major importer of the world, is not only is there this big supply of dollars in the world right now, but other central banks, because the U.S. wants to be the consumer of the world, other central banks have suppressed their currency and propped up the dollar relative to their currency, giving a kind of an artificial support to where the dollar would have been had this not been taking place, to make it more advantageous for the U.S. to be the consumer of the world. So other countries have seen it beneficial to export to the U.S. for whatever reason. They want the dollars, the U.S. wants the goods. There's this transaction taking place there, and in order to facilitate that, in order to encourage that, other central banks have suppressed their currency, and this has made the dollar stronger, and it's made it more enticing for U.S. consumers to buy stuff overseas. However, something really big happened about a year ago, or about at the start of the year, that we mentioned at the outset, and that is Trump took office and made it very clear that he was going to come very heavy-handed with tariffs, with trade policy, where he wants to reverse this course, right? He wants the U.S. to be the major exporter to the world, and the rest of the world to consume the goods that the U.S. are going to be making. And this changes the dynamic. And this is kind of the Mosler hypothesis here, that this dynamic is reverting. And now the central banks have nothing to target. There's no USD there to target, to export to, because the president decided, we don't want this. We don't want your stuff. We want to be making this stuff for you. We want your money for our stuff, not the other way around, that we're the ones apparently getting ripped off in that scenario, and they're the ones that are benefiting. He wants to reverse that. Whatever your take is, it doesn't matter. That's what's happening, and it's the underlying dynamics that are the concern. Why? Because when other central banks have supported the dollar, it has created, in a real sense, a benefit for the U.S. because the dollar was essentially stronger than it would have been had other central banks not been trying to do this. And now there's going to be, not in nominal sense, but in a real sense, damage to the spending and credit creation in terms of what it can buy, because the dollar is going to go lower when these new dollars are going to be created. And so since there is no more targeting the USD to favor exports, you're going to get a collapse of the most important spending that supports the macro structure. You're going to get a collapse of the real deficit spending. And we've seen this in the past play out. We saw this, say, in 91 with the oil shock. We saw this 2 times play out in the 70s when we had major inflation, that even though technically we were still running deficits, in a real sense, inflation adjusted, we were not spending enough to offset the demand for new dollars. And then ultimately you get that collapse that causes a market crash and a potential slower recovery than what we've seen over the last 15 years when we reach the end of the credit cycle. Because, as we mentioned, and I said this was going to be important, when the automatic stabilizers kick in, over the last 15 years, they've done so in an environment where the new money being created is coming into a very strong, real fiscal support environment, right? Relatively disinflationary. Well, in this scenario, it's not going to be a disinflationary environment. It's going to be effectively an inflationary environment. And so that is the big concern in terms of how we get to this kind of dollar collapse leading to a market crash. So whereas in the late 90s into the dot-com bubble, we actually just saw fiscal collapse. We saw ourselves into a both nominal and real surplus. In this instance, we might not ever end up seeing the nominal surplus, but in real terms, we can find ourselves there very, very quickly as the dollar continues to collapse, because the main support, or one of the main drivers for supporting the dollar over really 30 some odd years now, but more so over the last 15 years, is this foreign exchange targeting by other central banks. And look, this is a real concern. If you watch this channel for a while, you know I am not one to go with the bear vibes all that often, but this is starting to concern me, and I think it's something that definitely needs to be watched. So what are some things that I'm going to be looking for as we move forward in terms of which way is this going? Because as it stands right now, it could be playing out in scenario one. We're seeing credit expansion. We're seeing the kind of the macro cycle kick up here. We're seeing everything play out exactly as you'd expect, and you would also expect and anticipate the dollar to push lower. So what is it that we really want to pay attention to here? A couple things. Is dollar hedging stopping? What do I mean by this? A lot of large institutions that need to hedge relative to asset accumulation, they need to hedge foreign exchange exposure. Again, because of the last, say, 15 some odd years, the dollar has performed so strongly. If you're going to buy assets, equities, that sort of thing outside the U.S., you want to make sure that the dollar isn't diminishing your returns. So those hedging flows also help reinforce and support the dollar cycle that we've seen. There's indication that that's already giving way, and if that continues to give way, that's more of a concern that the dollar's just pushing lower, that trend gets reinforced and established in the other direction, meaning downwards, meaning those flows stop, and that continues to deteriorate the real fiscal support that the U.S. has had the advantage of over the last 15 years. So that's kind of the first thing I want to keep an eye on. The next thing is, what are inflation expectations? Do bonds keep falling? And look, we're getting the president right now threatening Jerome Powell. He's about to kick him to the curb, and replace it with someone that effectively would put rates back to zero. And yet we continue to see bonds really struggle. They continue to fall, rates continue to push higher. So you have the president saying, I'm going to get rates back to zero, which in theory he absolutely could pull off and just force the entire curve back down. But the bond market is saying, yeah, I think inflation is going to be a little bit trickier than you think, Mr. Trump. And so look, that is another thing that we need to keep an eye on, is inflation expectation and where we're going. The last thing is someone else, and this is the biggie, and this is why I'm not completely sold on this hypothesis that we're going to see the dollar collapse. The last thing is we need someone else to step up to become the new spender. And really the only part of the world that really has the capacity to do this, the institutions and infrastructure to do this still left over, is Europe. And it looked like for a brief moment that Europe was going to do that, right? We saw this massive spending proposal, and it got rejected. Germany rejects this massive spending proposal. I think France also had some spending proposals they put forward that have started to roll back. So at this point, we're seeing no one else really step up to the plate to become the big spender, to become the big importer, to become the de facto go-to kind of new dollar regime where the credit cycle revolves around. So at this point, Europe had its chance. It's kind of whiffing at it and deciding that it just wants to continue with austerity for whatever reason. So at this point, even despite the cuts that we've seen in spending on the U.S. side, we still are a fiscal juggernaut. And if it remains that way, and if the U.S. kind of remains the only spender on the block, I think there is still a good case to be made that we return back to the long-term dollar uptrend and the world goes back to normal. But if someone else stands up, or the damage is just too much, then we could really find ourselves in a lot of chaos in the next couple months here as we head into 2026. So that's what I'm going to be watching. That's kind of the roadmap here for what we need to understand with the dollar index. So that's what I have for today. Look, if you are an active trader, active investor, and you like this sort of analysis, make sure you head on over to appliedmmt.com. That's where you can get access to my updates, all the data, all the tools, all the models that I use to make the decisions on a day-by-day, week-by-week, month-by-month basis. Yeah, head on over there, active trader, active investor, appliedmmt.com. Until next time, good trading, everyone. And just remember to follow the flows. That's the key. Follow the flows. Good trading. We'll talk to you next time. Bye-bye.